Chapter 10. The ABT Tax.
In 1776, Adam Smith wrote in The Wealth of Nations that all fair and equitable tax structures meet 4 criteria.
1. Taxes are proportionate to the incomes and abilities to pay. 2. Taxes are certain and predictable rather than arbitrary. 3. Taxes are payable at times and in ways convenient to the taxpayer. And 4. Taxes are cheap to administer and collect.
When we apply these criteria and consider the issue mathematically, a simple solution becomes apparent, which includes lowering tax rates for all by finding the broadest possible tax base. And here's what we know without question. The widest possible base consists of all financial transactions within the U.S. economy. The answer, then, is to forget about taxing both individuals' salaries and corporations' profits, and instead to tax all banking transactions within the economy. A transaction tax system is not only theoretically possible, it is technologically achievable. By harnessing already existing banking technology and implementing a comprehensive strategy into a national automated banking transaction tax, ABT tax, the U.S. could revolutionize its tax system. Instead of relying on roughly 150 million working people to provide almost the entirety of the U.S. budget, by paying a large percentage of their salaries in taxes, in turn we can tax hundreds of trillions of dollars in financial transactions at a tiny numerical rate, vastly increase the equity of the tax system, and provide solvency to the nation. This would be the widest tax base possible, which would permit the lowest tax rate possible. Mathematically, this structure provides far lower rates for everybody, rich and poor, while also dynamically promoting the free market. Under a transaction tax system, all parties in the U.S. economy would be free from undue and at times unseen governmental tax burdens, and the most fair and efficient prices for goods and services will emerge to the benefit of all of society. If we were to tax every banking transaction, every debit, every credit, by automatically extracting a small portion of the amount and paying it to the Department of the Treasury, we could lower the tax rate to 1%. That would be a half of 1%, 0.5%, to each debit and a half of 1%, 0.5%, to each credit, totaling to a 1% tax for the transaction shared by each side. Because everyone will pay taxes by taxing a total of 1% of each banking transaction in the U.S., the extent of the federal government's expenditures, around $6 trillion in 2023, would be more than covered. And in turn, when we tax a total of 1% of each transaction, we eliminate all other federal taxes. Let that sink in. With the ABT tax, we would eliminate income taxes, no more payroll deductions and deposits required, and no more payroll, Social Security, or Medicare taxes. We would eliminate the capital gains tax and taxes on corporate profits. What's more, there would be no individual or corporate tax returns filed, no declaratory self-filed returns. This may sound fantastical to some, but the concept has been around for centuries. As mentioned, in ancient Rome, Julius Caesar implemented a 1% tax, which proved impossible to collect. And in the 1700s, the single tax was proposed by the physiocrats. Initially, it was considered a tax on land, and then later a tax on incomes and transactions. In the 20th century, several Latin American nations attempted a form of the single tax, though never as an exclusive tax. They instead implemented a transaction tax in addition to their existing taxes. In the 1980s, Professor of Economics Edgar L. Feiger developed the proposal for the Automated Payment Transaction APT tax, which garnered national and international support. Over the years, numerous advocacy and nonprofit organizations emerged dedicated to the concept of a transaction tax in some form or another. Standing on the shoulders of all these earlier transaction tax proposals, the ABT tax offers an evolved, refined, and advanced concept that can be effectively applied due to enhanced technology in today's modern economy and demonstrate with mathematical accuracy its effectiveness. To date, no country has instituted the broad ABT tax strategy as a technology-based replacement for its existing tax system. However, with its unique modifications to overcome some very specific issues and resistance, current innovations have made it, at long last, possible. To start, let us illustrate how the ABT tax works. Say you earn a $100,000 salary in a year. When the $100,000 leaves your employer's bank account, 0.5% is paid automatically by your employer's bank to the U.S. Treasury, or an amount of $500. Then, once the remaining $99,500 arrives in your account, your bank sends another $500 to the Treasury. You and your employer share the burden of the 1% ABT tax in equal amounts, and the $99,000 balance in your bank account remains untouched for tax purposes until you make another transaction with it. At the end of the year, assuming you spend or turn over the $99,000 only one more time, as opposed to repeatedly buying and selling things of value, then your $2,000 of tax will replace the approximate $25,000 you would have paid under the current tax system. How, you may wonder, is this possible? It is possible because everyone in the economy pays the ABT tax. Individuals and corporations, wealthy and poor, residents and visitors, Republicans and Democrats. No one is exempt. When everyone pays with no exceptions, all tax dollars would be gathered through technology. The tax rate shrinks to its lowest possible percentage, yet still produces the necessary revenue to cover the federal government's costs. To fully understand the possibilities of the ABT tax, let us consider the economic concept of income or dollar turnover. The general premise asserts that each dollar earned in an economy will circulate or turn over multiple times. This concept is complex, and it's important to acknowledge that economists do not fully agree on the details of the principle. Some have postulated that as a dollar is earned, there is a multiplier effect, i.e., as the dollar gets spent several times in an economy, which impacts local markets. Others argue that the principle should be thought of as the velocity of money, i.e., the rate at which an individual spends their cash, or how often the dollar is used to make purchases. Depending on the data examined, a dollar earned might be considered to turn over 2 times under the velocity of money theory, and as many as 7 times under the multiplier theory. Let's imagine you are a manager at Walmart. The average Walmart has annual gross revenue of $65 million. Under the ABT tax, shoppers have paid 0.5% in transaction taxes on the front end of that $65 million, and your Walmart will have paid the remaining 0.5% upon depositing the money. Then, out of this gross revenue, Walmart pays your salary of $100,000. As this money leaves Walmart's account, 0.5% tax is paid. Upon reaching your account, you pay the next 0.5%. At this point, these Walmart dollars have experienced 2 turnovers. In other words, 2% of each Walmart circulated dollar. Walmart and the shopper or buyer make up 1%, and Walmart and the employee another 1%, has been paid in tax by all the parties. Then, let's say you pay rent on your apartment. Again, a 0.5% transaction tax is paid at either end of this exchange. The third turnover brings us to 3% of each dollar paid in tax. Next, your landlord pays a lawn maintenance company to cut the yard at your building. With this 4th turnover, the landlord and the maintenance company share the 1% burden, bringing us to 4% of the circulating dollar. Let's say the lawn company purchases a new Ford truck. Then we have the 5th turnover, and 5% of the circulating dollar is paid in tax. The salesman at the dealer makes a commission on the sale of the truck, and he, along with the dealer, share the 1% burden, meaning that with the 6th turnover, 6% of the dollar has been paid in tax. Then, once the salesman visits Walmart and pays for groceries, he'll share the 1% burden of the goods he buys with the store, and the remaining money will return to Walmart as revenue. At the end of this cycle, 7% of the circulating dollar has been paid in tax. In reality, as dollars turn over, they mingle with other dollars and divide into pieces as they travel within or out of a community. Regardless of the total number of turnovers a dollar might experience, turnovers equal equitable tax burdens under the ABT tax, so that each time a dollar is used or circulates, each party pays their taxes as they use the structure of government to operate in the economy, with no exemptions. Mathematically, the tax rate is very low, yet more than enough tax revenue is fairly and equitably collected by the government. Alternatively, today the income tax on a salary of $610,000 is 37%, the Social Security tax is 6.2%, and the Medicare tax is 2.35%, adding up to a total tax on the salary of 45.55%. And this does not include the employer's Social Security matching tax of another 6.2%. And today, on a salary of $101,000, income tax is 24%, and Social Security and Medicare is 7.65%, adding up to a total of 31.65%. Now compare that to an ABT tax system of 1% on transactions. Then further compare that with the assumption that the money will turn over 7 times in an economy. That makes a 7% tax, paid by up to 7 different individuals or companies. Let us look at the table. Summary comparison: taxes collected under the IRS code and the ABT tax system. To see this table, summary comparison: taxes collected, go to the website disruptingtaxes.org. The effectiveness of the ABT tax is based on a very simple concept. When everyone pays taxes, individuals and corporations, the rate can be 0.5% per each side of an individual transaction for a total of 1%. As we see, individuals pay 0.5% on their side of the salary payment when earned, and then an additional 0.5% on their side when they spend their salary, for a total tax of 1%. To make it even more effective, the power of the ABT tax is compounded under the concept of an economic turnover of $1 as it passes through the economy. If the average turnover is 7 times, then that dollar will contribute the 1% tax 7 times as it circulates, amounting to a total tax collected of 7% on the circulated dollar. Each dollar is earned and spent as part of all banking transactions in the U.S., helping to achieve the largest tax base possible. Moreover, the power, clarity, equity, and effectiveness of the ABT tax truly comes into focus when applied to corporations. Yes, it is true that Amazon did not pay any taxes in 2018, and many major corporations did not pay any taxes in 2020. But as we see in the table, Amazon did pay $1.7 billion in taxes in 2020, which was based upon $21 billion in profit from a total revenue of $386 billion. It gets a little complicated fleshing out the math, but as we saw in the chart, by looking more closely at what happens to Amazon's total revenue and profit under the ABT tax, the picture starts to become clear. Because the buyer in Amazon would pay a total of 1% tax, Amazon would receive about $382.14 billion out of $386 billion in revenue and contribute the 0.5% or $1.92 billion in taxes at the gross revenue level. In 2020, Amazon's total costs were about $361 billion, leaving a net profit of $21 billion. Under the ABT tax, as Amazon spend this $361 billion in costs, it would contribute 0.5% in tax, or $1.805 billion in taxes paid. So under the ABT tax, Amazon would pay $3.725 billion in taxes, $1.92 billion plus $1.805 billion in total for 2020, which would be more than double the $1.7 billion Amazon paid under the current tax code. So because all companies pay taxes, even those that legally have not paid under the loopholes of the current system, overall revenues increase. This is how it is possible for the ABT tax to raise the needed government revenue. And remember, Amazon still has close to $20 billion in annual profits to utilize. The truth is that corporations do want to pay their fair share of taxes, and one can imagine that Amazon would embrace the ABT tax as it is equitable and contributed to by everyone. Equally interesting and dynamic is the magic of applying the ABT tax structure to Adam Smith's 4 criteria of sound tax policies. As we recall, number 1, taxes are proportional to income and ability to pay. A 1% tax on all transactions is mathematically the most proportionally possible tax, and because everyone pays at a low 1%, this is a tax everyone has the ability to pay, even the poor. Then 2, taxes must be certain, not arbitrary. No tax can be more certain and less arbitrary than the ABT tax. Number 3, taxes need to be payable in ways convenient to the taxpayer. With modern technology doing all the work, the ABT tax is the poster child for the most efficient manner of paying taxes. And 4, the tax should be cheap to administer and collect. Again, with today's advanced technology, the ABT tax is very cost-effective in both collection and administration. There would be no IRS needed, no filings, no paperwork. All taxes would be collected automatically via the banking system,